Friends, thank you for being here today. We are standing at a peculiar moment in history, a moment where the numbers on our screens and the reality of our economy seem to be living in two different universes. We need to have a serious conversation about wealth, history, and the seduction of the next big thing. What if I told you that the financial ground beneath our feet is currently more precarious, by strictly mathematical standards, than it was just before the Great Depression of 1929? And to add to that sobering thought, I must ask, are we witnessing the dawn of a new utopia that will justify these sky-high stock prices? Or are we sleepwalking into a financial correction that could wipe out a generation of wealth for those who are not paying attention? These are not questions to be taken lightly, nor are they born out of pessimism. They are born out of a careful study of the data. We are going to walk through a unified analysis of our current market situation, stripping away the hype and the headlines to look at the raw mechanics of what is being called the AI bubble. We will look at why this bubble might not just be a repeat of the past, but potentially something more volatile. To begin our analysis, we must look at a historic warning regarding valuations that have become detached from reality. To understand where we are going, we must first understand where we are standing. If you open the financial pages or turn on the business news, you will see a lot of celebration. The markets are hitting record highs. Portfolios are looking robust. But if we peel back the layers and look at the price tags of these companies compared to what they actually earn, a different picture emerges. First and foremost, we cast our eyes back to the shadow of 1929. The most reliable metric we have for market sanity is the price-to-earnings ratio, or the PE ratio. Simply put, this measures how much you are paying for every dollar of profit a company makes. When this number is low, stocks are cheap. When it is high, stocks are expensive. Right now, according to data from the Financial Times and long-term historical charts, U.S. stock valuations are higher than they were immediately before the 1929 Wall Street crash. Let that sink in for a moment. We are paying a higher premium for future earnings today than investors did right before the greatest economic collapse in modern history. Furthermore, if we look at the cyclically adjusted PE ratio, beyond the historical comparison, we must also address the extreme concentration of risk in today's market. In a healthy market, a broad range of companies drives growth. Manufacturing, retail, transportation, and banking usually share the load. Today, we have a very different situation. We have a market that is essentially being held up by a handful of companies. Currently, 5 AI-adjacent companies represent over 30% of the entire S&P 500. This is the highest concentration of market power in modern financial history. We have created a single point of failure for the American economy. If the narrative around artificial intelligence falters, there is no backup engine to keep the plane flying. Consider the speed of this inflation. In just 18 months, over $3.3 trillion flooded into AI-linked companies. To put that number into perspective, that is more money than the entire market capitalization of Germany. We have pumped the value of an entire major European nation into a single sector in less than 2 years. I want to pause here and ask you a question. Do you think this level of spending and extreme market concentration is sustainable, or are we looking at a dangerous anomaly? I would love to read your perspective and hear what you are seeing in your own corner of the economy, so please let me know in the comments below. There's perhaps no clearer example of this phenomenon than the Nvidia anomaly. This company has become the poster child for the AI revolution. Since 2023, Nvidia alone has added more market cap than the combined gross domestic products, GDP, of South Korea, Sweden, and Switzerland. Think about that. One company, which makes computer chips, is effectively valued higher than the total economic output of 3 advanced industrialized nations combined. But here is where the danger lies. The market has priced imperfection. Even when Nvidia reports earnings that beat expectations by billions of dollars, numbers that would historically send a stock soaring, the stock often falls or drags the market down. Why? Because the expectations are so high that they are mathematically impossible to satisfy permanently. We have reached a point where reality, no matter how good, cannot keep up with the fantasy we have priced into the stock. Moving on from the valuations, let us examine the mechanics of the bubble, specifically the concepts of reflexivity and circular financing. You might be asking, if the prices are so high and the risk is so obvious, why does the market keep going up? To answer this, we have to look at the psychology of the market. This isn't just about numbers, it's about human behavior. To understand this, we need to discuss the reflexivity loop. There is a concept in finance known as reflexivity, popularized by the legendary investor George Soros. Most people think of the stock market as a thermometer, a passive device that simply measures the temperature of the economy. If the economy is hot, the market goes up. If it's cold, it goes down. But that is not how bubbles work. In a bubble, the market acts like a thermostat. It doesn't just measure the temperature, it changes it. Here is the cycle we are currently trapped in. First, a narrative emerges that AI will change everything. Next, this hype attracts speculative money. Then, the influx of money pushes stock prices up. Subsequently, investors look at the rising stock prices and say, "See, the price is going up, so the hype must be true." Finally, this belief attracts even more money, which pushes prices even higher. This creates a gravitational pull where belief drives prices, not business fundamentals. We are not buying stocks because of what these companies are earning today. We are buying them because we believe someone else will pay more for them tomorrow. It is a game of musical chairs, and the music is playing faster and faster. Beneath this psychological loop, we find a disturbing financial mechanism often described as an incestuous money trail. We are seeing evidence of what can be called circular financing or round-tripping revenue. Here is how it works. A massive tech giant, let's call them Company A, invests billions of dollars into a promising AI startup, Company B. This looks like a strategic investment. However, a condition of that investment is often that Company B must use that money to buy cloud computing services or chips from Company A. So Company A hands money to Company B, and Company B hands it right back to Company A, who then records it as revenue. It artificially inflates the growth numbers. It creates the illusion of organic demand where there is only financial engineering. It is incestuous, it is circular, and historically, this kind of accounting gymnastics appears right before the music stops. This situation is compounded by fiscal dominance, which effectively places handcuffs on the Federal Reserve. In previous bubbles, like the housing market in 2007 or the dot-com era in 2000, the Federal Reserve, the Fed, had the power to step in. They could raise interest rates, make money more expensive to borrow, and cool down the speculation. But this time is different. We are living in an era of fiscal dominance. The United States government is currently carrying a debt load that is historically unprecedented. Because of this massive debt, the Federal Reserve is trapped. If they raise interest rates high enough to truly pop this speculative bubble, the interest payments on the U.S. government's debt would become unmanageable. They would essentially bankrupt the Treasury. So the Fed is forced to keep liquidity in the system. They are forced to keep printing money or keeping conditions looser than they should be to keep the government solvent. This creates a forced liquidity environment. There is so much cash sloshing around the system with nowhere safe to go that it pours into the highest risk, highest reward assets available, AI stocks. We are inflating the bubble not because the technology justifies it, but because the monetary system leaves us no choice. Now, we must step back and perform a profitability reality check to ask, where is the actual money? Let's step away from the stock prices for a moment and look at the actual businesses. If you own a local hardware store, you know that eventually you have to sell enough hammers and nails to pay the rent. The same rule applies to trillion-dollar tech companies. Despite the hype, we are starting to hear grave warnings from CEOs. While the media headlines scream buy, 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 the people actually running these companies are starting to whisper warnings. The CEO of IBM recently stated, quite bluntly, that there is no way that all this massive spending on data centers and AI infrastructure will ever be able to pay off at the current trajectory. That is a shocking admission. We are spending hundreds of billions of dollars building data centers, hoping that future profits will justify the cost, but the math isn't adding up. Look at Oracle, a company that was once a fortress of cash. Oracle has been a profitable, stable company for decades, but recently their behavior has changed. They are borrowing massive amounts of money, going into debt, to fund their AI expansion. Their free cash flow, the money they actually keep after expenses, is turning negative. They're gambling the health of a legacy company on the hope that AI will generate massive profits next year or the year after. If it doesn't, they're left with the debt, and the investors are left with the bag. Broadcom, another major chip supplier, has also failed to live up to the parabolic hype. When a company is priced for perfection, any slowdown, even a small one, is treated as a disaster. Another critical issue we face is the widening productivity gap. The promise of AI is that it will make us all super productive. We are told it will double our output, solve our problems, and usher in a golden age. But if we look at the macroeconomic data, that revolution is missing in action. While investment in AI has exploded by 800%, U.S. productivity has barely budged, up only about 1.3% total in 2 years. Reports from major financial institutions like Goldman Sachs and McKinsey are starting to pour cold water on the fire. Even their most aggressive estimates suggest AI might only boost productivity by 1% to 3% over the long term. That is a nice increase, certainly. But does a 3% increase in productivity justify stock valuations that are 150 times higher than revenue? The math simply does not support the price. Furthermore, we must confront what is known as the wrapper problem facing many AI startups. A recent report indicated that nearly 70% of AI startups have yet to earn a single dime in revenue. Many of these companies are what technical experts call thin wrappers. They don't own their own technology. They don't have a proprietary moat around their business. They are simply building a pretty website that sits on top of ChatGPT or another foundational model. They are reselling someone else's intelligence. When the dust settles, these companies will have no competitive advantage. They are the modern equivalent of the thousands of .com websites that vanished in 2001 because they didn't actually do anything unique. History offers us valuable guidance here, so let us look at the parallels and lessons from the railways and the .coms. History may not repeat itself exactly, but it certainly rhymes. To understand the AI bubble, we simply need to look at the railway mania of the 1840s and the .com bubble of the late 1990s. First, consider the lesson from the railway mania of the 1840s. In the 1840s, the United Kingdom went crazy for trains. And let's be clear, trains were a real revolution. They changed the world. They changed how people traveled, how goods were moved, and how wars were fought. The technology was valid. However, the investment bubble was a disaster. Caught up in the mania, investors funded railways to nowhere. They built lines between small towns that could never provide enough passengers to pay for the tracks. When the bubble burst, railway stocks tumbled to 1/3 of their peak. Fortunes were lost. Projects were abandoned in the mud. Here is the crucial lesson for today. A technology can be revolutionary, and the investment can still be a failure. The trains kept running after the crash, but the people who bought the stock at the top went broke. AI will likely change the world, just like the trains did, but that does not mean the company you bought at 100 times earnings will survive. Fast forward to modern times, and we can see a clear replay of the .com era. For those of us old enough to remember the late 90s, the current mood is eerily familiar. Back then, if a company added .com to its name, its stock would double overnight. Today, if a company mentions AI in an earnings call, its stock jumps. In the year 2000, investors poured money into over 4,700 internet companies. They were convinced the internet was the future, and they were right. The internet was the future. But here's the catch. Most of those 4,700 companies went to zero. Pets, Com, Webvan, eToys, they all vanished. Even the companies that survived and became giants like Amazon and Cisco took investors on a brutal ride. If you bought Amazon at the peak of the bubble, you lost 90% of your money before it started to recover. It took 15 years for the NASDAQ to get back to its previous high. The lesson from the .com era is about picks and shovels. The companies that survived were the ones building the infrastructure, the plumbing of the internet. In the AI gold rush, the safest bets are likely the infrastructure providers, not the flashy consumer apps. But even they are not immune to a price correction. If you are enjoying this deep dive into market history and want to see more content like this, please hit the like button and subscribe to the channel. Your support helps us spread this crucial message to more people. You might hear that this time is different, but we need to understand why our current economic house of cards makes this time uniquely dangerous. There is an argument that we should ignore these warnings because this time is different. And in one terrifying way, it is different. The structural health of the U.S. economy is weaker today than it was in 1929 or 2000. A major concern is that AI appears to be the only pillar left supporting the market. We are living in what some economists call the forgot how to grow economy. We are no longer the manufacturing powerhouse of the world. Much of our economy has become financialized. It's about moving money around rather than making things. Right now, the AI bubble is arguably the only thing holding up the U.S. stock market. Other sectors, retail, transportation, traditional manufacturing, are flat or declining. If you remove the magnificent 7 tech stocks from the S&P 500, the market performance for the last year looks dismal. This means we have no safety net. If the AI bubble bursts, there is no other booming sector to catch the falling economy. This fragility brings us to a critical point regarding the wealth effect and the American retiree. This brings us to a critical point for those in retirement or approaching it. Our current economic stability is heavily reliant on the wealth effect. Baby boomers and older Americans hold a significant amount of the nation's wealth. Much of this is tied up in the stock market and 401ks. Because these accounts are currently high, thanks to the AI bubble, people feel rich. When people feel rich, they spend money. They go out to dinner, they travel, they renovate their homes. This spending is what is keeping the U.S. GDP positive, but this is a fragile dynamic. If the market corrects by 20% or 30%, a standard drop for a bubble popping, that feeling of wealth evaporates instantly. Spending stops. And because consumer spending is 70% of the U.S. economy, the recession that follows would be swift and brutal. We also cannot ignore the brutal K-shaped reality of this economy. While the stock market soars, the labor market is quietly bleeding. Despite the low unemployment headlines, the economy is shedding tens of thousands of full-time jobs per month, replacing them with part-time or gig work. We see the stress in the earnings of companies like Target and McDonald's. These companies are reporting missed earnings because the average American, the one who doesn't own $1 million in Nvidia stock, has stopped spending. They are tapped out. This divergence creates social instability and economic fragility. A market that only works for the top 10% is a market that is built on sand. However, beyond these structural weaknesses, there are hidden accelerants waiting in the wings, specific forces that can turn a manageable market correction into a historic crash. We must speak about the gasoline that has been poured on this fire: leverage. It is crucial to understand that markets rarely crash simply because stocks are expensive. They crash because investors are forced to sell, and nothing forces a sale faster than leverage. In the last year, margin debt, the money borrowed by investors to buy stock, has hit a staggering $1.1 trillion. Think of margin debt as a multiplier. When the market is going up, it is a miracle drug. It amplifies your gains and makes you feel like a genius. But when the market turns, leverage becomes deadly. It creates a mechanical trap. Unlike a cash investor who can simply wait out a downturn, a leveraged investor gets a margin call. The broker demands immediate cash to cover the loan. If the investor cannot pay, the broker sells their stock automatically, without asking for permission. This forced selling drives prices down further, which then triggers margin calls for the next group of investors. It creates a liquidity cascade or a doom loop. We are currently sitting on a mountain of this debt, and history tells us that when this mountain crumbles, asset prices can be cut in half in a matter of weeks. The $1.1 trillion figure is not just a number, it is a measure of the potential velocity of the next crash. While the retail public is borrowing record amounts of money to chase this rally, we must ask a very uncomfortable question: what is the smart money doing? The behavior of insiders offers a chilling counter-narrative to the optimism we see on television. While everyday Americans are pouring their 401ks into AI ETFs, the insiders, the CEOs, the billionaire founders, and the legendary hedge fund managers are selling at a record pace. This phenomenon is known as the distribution phase. In every major market cycle, there's a period where the smart money quietly hands off their shares to the dumb money at peak prices. We see this in the filings. Tech executives cashing out hundreds of millions of dollars in stock options, while simultaneously telling the public that the boom is just beginning. Perhaps the loudest signal of all is the silence of Warren Buffett. His company, Berkshire Hathaway, is currently sitting on a record pile of cash, having sold off significant portions of his holdings, including Apple. Buffett is famous for saying, "Be fearful when others are greedy." His cash hoard suggests he is preparing for a storm, securing a life raft while the band continues to play on the deck of the Titanic. This divergence, where institutions sell while retail investors buy on credit, is the ultimate warning sign that the top is near. Finally, we must reckon with the structural danger of modern passive investing and the concentration trap. Most Americans today invest through passive ETFs, exchange-traded funds that track the S&P 500. This sounds safe, but because of the extreme concentration we discussed earlier, it has created a dangerous crowding effect. When you buy the S&P 500 today, you're not buying a diversified basket of 500 companies. You are largely buying the same 5 or 7 AI stocks that everyone else owns. This works beautifully on the way up, creating a self-reinforcing loop of buying. But imagine a theater where everyone is standing near the stage, and the exit doors are very small. If panic strikes, perhaps triggered by a margin call cascade, everyone tries to sell the same 7 stocks at the same time. The liquidity dries up. The buyers vanish. And because the algorithms that run these ETFs are programmed to sell automatically when prices drop, the decline accelerates. We have engineered a market structure that is optimized for speed, but that speed works in both directions. But there is one final, silent pillar of this house of cards that we must examine, one that connects the high-flying world of AI stocks to the very real and mundane world of bank deposits and corporate loans. We must talk about the fragility of the banking system and the looming corporate credit wall. When we think of a stock market crash, we often think of numbers flashing red on a screen, but the real pain, the kind that leads to mass unemployment and economic depressions, happens when the banking system freezes. In 1929, the market crashed, but it was the subsequent failure of thousands of banks that destroyed the economy. Today, we are seeing cracks in the foundation that look disturbingly similar to the pre-crisis periods of the past. We are currently witnessing a dangerous trend of deregulation and consolidation in the banking sector. The protections put in place after 2008 are being slowly eroded. Regional banks, which are the lifeblood of small businesses in America, are under immense pressure. They are sitting on massive losses from commercial real estate, empty office buildings that will likely never be filled again due to the very remote work technologies AI is accelerating. If these banks fail, the credit crunch that follows will strangle the economy, regardless of how innovative Nvidia's new chip is. This brings us to the corporate debt bubble, often referred to as the shadow banking risk. A significant portion of the AI boom is being funded not by profits, but by debt. We mentioned Oracle earlier, but they are not alone. Across the Russell 2000, the index of smaller American companies, Nearly 40% of companies are unprofitable. These are what economists call zombie companies. They only stay alive because they can borrow cheap money to pay off old debts. But money is no longer cheap. With interest rates staying higher for longer to fight inflation, these companies are facing a wall of maturity. Billions of dollars in corporate loans are coming due in the next 2 years. If the AI bubble bursts and stock prices fall, these companies will lose their ability to raise cash by issuing stock. They will be unable to refinance their debt. The result will be a wave of corporate bankruptcies that will ripple through the banking system, causing lenders to pull back precisely when the economy needs liquidity the most. Furthermore, we must look at the consumer credit reality. The American consumer is the engine of the global economy, but that engine is running on fumes. Credit card debt has hit an all-time high of over $213 trillion, and delinquency rates are rising at the fastest pace since the 2008 financial crisis. People are not borrowing to buy luxury goods. They are borrowing to buy groceries and pay rent. This creates a terrifying feedback loop with the AI bubble. The current economic stability is an illusion maintained by asset price inflation, the wealth effect, and consumer debt. If the AI bubble pops, the wealth effect vanishes. Simultaneously, as the economy slows, the consumer, already maxed out on credit cards, cannot step in to save the day. They default on their loans. These defaults hit the balance sheets of the banks. The banks, terrified of losses, stop lending to businesses. Businesses, unable to get credit, fire workers, and thus, a stock market correction transforms into a full-blown economic depression. This is why the AI bubble matters to you, even if you don't own a single share of stock. The financial system is interconnected. The leverage in the stock market, the fragility in the banking sector, and the debt on the consumer's credit card are all wired together. When the fuse is lit in the stock market, the explosion happens in the real economy. We are looking at a potential credit crunch that could make capital inaccessible for years, freezing innovation and growth in a way that no AI chatbot can solve. So, facing all of this, the valuations, the leverage, the insider selling, and the systemic banking risks, how do we go about weathering the storm? I'm not here to tell you to sell everything and hide cash under your mattress. Panic is not a strategy. However, blind optimism is not a strategy either. The verdict of the data is clear. The AI revolution is likely real, but the timeline and the valuations investors have placed on it are mathematically impossible to sustain. We are likely looking at a correction. Here's a strategy for the wise, for those who want to protect what they have built. First, don't chase the hype. If you hear about a hot new AI stock that has no revenue but a great story, walk away. Avoid the fear of missing out, FOMO. At this stage in the cycle, you are more likely to be the greater fool buying at the top than the genius buying at the bottom. Second, focus on fundamentals. Look for companies that make real money, pay dividends, and have tangible assets. Cash flow is king. In a recession, a company with cash survives. A company with only a narrative dies. Third, diversify your holdings. If your entire portfolio is concentrated in technology stocks, you are taking on a level of risk that is dangerous for anyone near retirement. Rebalance. Look at other sectors. Look at bonds, commodities, or defensive stocks that people need regardless of whether AI takes over the world. Finally, have patience. Remember the dot-com lesson. The people who made life-changing wealth from Amazon and Google didn't buy them at the peak of the frenzy in 1999. They waited. They let the crash happen. They let the dust settle. And then they bought the survivors for pennies on the dollar. Friends, the most dangerous 4 words in investing are, "This time is different." The technology changes, but human psychology does not. Greed, fear, and the laws of mathematics remain the same. We may indeed be heading for a future of incredible artificial intelligence, but we must ensure that our personal financial intelligence is just as strong. Protect your nest egg. Stay skeptical of the hype. And remember that in the game of investing, survival is the only way to win. Thank you.